Good day. In this video, a financial feasibility analysis is illustrated to determine what the best investment action will be for a certain Mrs. Smith who would like to either rent or sell her apartment. She's been given three options that will all have a planning horizon of 5 years. The three options that she has been given are: Option 1, to rent her apartment unfurnished on a year-to-year basis using the services of a rental agent. Option 2 is to rent her apartment on a short-term basis through using either Airbnb or Lacaslav. It is mentioned now already that Airbnb has a cheaper service fee than Lacaslav and will be used in the analysis. Option 3 is to sell her apartment through an agent and invest in a portfolio of a maximum of 3-unit trust. The three options will be analysed and discussed, and the final choice will be suggested for Mrs. Smith. Option 1 is indicated here. We know that Mrs. Smith has an income that consists of her personal salary, loan repayment, and rent from the tenants. Her expenses consist of the loan repayment, repairs and upgrades that need to be done on the apartment, new appliances that will need to be integrated, maintenance costs per year, levies, rates and taxes, as well as the agent fee. Her property value of her apartment was $720,000 in 2014 when she bought it, and it is currently $920,000. Her personal income is $950,000 and escalates by 7% each year. The maintenance cost fee is estimated to be 1% of her property value. Tax rate is 41% of income tax. The rental agent's fee is 6% of rent income, and the capital gains tax is 18% of capital gains. Mrs. Smith's salary is within a tax bracket that is indicated over here, and therefore the rates of her taxes will be indicated here. The assumptions are for all three choices that the financial planning horizon begins on the 1st of January 2019. In this option, laminated flooring will be included in the analysis. The stove will be bought in the beginning of January 2019 to avoid any increase in costs for all three choices. And the apartment will be sold after the 5-year period. In order to work out any values for any future periods, we need to use inflation. Therefore, the past 14 years of inflation have been included in order to forecast the future 5 inflation periods. This is used when we look at our property value, in which we want to increase each year, and therefore we find the maintenance cost each year of the property value. Then we work out levies and rates and taxes. The rates and taxes in previous years were given in disjointed months, and therefore the weighted average cost of each of these levies or rates and taxes, as seen at the bottom, were worked out in order to work out the previous years of levies and rates and taxes, and thereafter to go and work out the forecast of the levies and rates and taxes. These would now be included within the operational expenses analysis. The agent cost was also included, which would be 6% of the rental income. Rental income for previous years was given and could be used to forecast rental income for the future 5 periods. Thereafter, we have our total expenses for option 1, and then we have our total income for option 1 as well. The laminated increase of R800 per year is due to the fact that laminated flooring is going to be included. Then we focus on the financing for option 1. First, the previous loan needs to be accounted for. The prime rate is 10.75% compounded monthly, and the effective interest rate is calculated to be 11.30%. Equal annual payments are calculated as can be seen here. Thereafter, we took out additional expenses for the repairs, for the upgrades, for the replacement of the stove, the laminate flooring, and the refinancing of the original amount. Therefore, our new mortgage loan amount would be R57,020. Thereafter, the equal annual payments for this mortgage loan are calculated, and the total mortgage loan expenses and interest for these two mortgage loans are calculated. Thereafter, the cash flow is calculated. We have our operational income, our operational expenses, our mortgage loan, and then the before tax cash flow. We also have our interest, our taxable income, and the tax, which is 41%. We also include the property sale, as we are selling the apartment after 4 years, and the capital gains taxable income. Thereafter, we have our after-tax cash flow, and we now need to work out our net present value. If we have a look at our MAR calculation, we know that our loan interest rate is 11.30%. Our rate of inflation is currently 4.34%. The expected rate of inflation change is 0.30%, and due to this being a very low risk loan and project, these are very low risks. Then we get our before tax MAR, our tax rate, and then our after tax MAR. And thereafter, we can calculate our net present value for option 1. Now, we will look at option 2. Option 2 has a lot of similarities to option 1, with some extra costs such as your service costs, your cleaning costs, and your occupancy rates. We have stated before that Airbnb will be used as they have lower agent fees than lacquer slab. We will not use any laminate flooring for the reason that these types of floors can be damaged more easily than tiles, and it is not too easy to claim damages back from Airbnb tenants. It is also indicated that the cleaning costs of tenants staying in apartments are approximately 80 Rand per night. The maintenance costs, levies, and rates and taxes are all the same as in option 1. However, your service costs, your cleaning costs, your agent costs, as well as your rental income are all dependent on the occupancy rates of whether or not there are people actually staying in the apartment at the time. Thereafter, we look at the mortgage loan. This loan is exactly the same as in option 1, as we are still paying off our current loan. However, when we look at taking out our second mortgage loan, we now do not include any laminate flooring. However, we do include furniture and interior decoration for option 2. Thereafter, we have our interest and our mortgage loan for the total of the 2 loans. We then take a look at our cash flow for option 2. Our operational income, mortgage loan, operational expenses are all calculated as before. Before tax cash flow is calculated with the interest, as well as our taxable income, the tax, and the property sale, and the capital gains taxable amount. Thereafter, we calculate our after-tax cash flow. We now do our mark calculations for option 2, which is again 11.30% for the loan interest rate. The rate of inflation is 4.34% with its change. The loan is at 2%. However, the project risk is slightly higher as it is risky to have an Airbnb apartment because there are chances of things not going right. Thereafter, our after-tax MAR is 13.53%, which results in a net present value as stated here. This brings us to our third but not final option, which is to sell the property to an agent and investment in a portfolio of a maximum of 3 unit trust. The financial planning horizon will still begin in the 1st of January. The plumbing issue still needs to be paid off. It is suggested that both the laminated flooring as well as the stove replacement are still done to increase the value of the property. We're assuming that the agent service fee is 6% and that the advisor fee is 8% on the expenses amount. The apartment will be sold at the end of December 2018 or the beginning of January 2019. It is suggested that the client could invest with Allen Gray. Then we look at our available investment price after the sale of property. We have a property value of 920,000, the fixed cost of 10,000, laminated flooring of 35,000, and our stove replacement of 5,000. This gives us a selling price of 970,000. We then subtract our capital gains tax and our agent fees. Thereafter, we have a total investment value of 866,800. We are assuming to invest with the Allen Gray Unit Trust Fund, and the percentage of return for each year as due to inflation is indicated here. We then have our cash flow as indicated. We have our property income, which includes the selling price of the apartments in the beginning of 2019, our personal loan that we take out, the salary of our clients through each year, the investment that she could get on a return, and the interest at the end of the year. Her property expenses will be the operating expenses as indicated before, the investment in a unit trust fund due to selling her property, the advisor fees of 8% each year, her loan repayment, which is the same as option 1, as we are still using the laminated flooring and all other expenses included. We then have our capital gains of 45,000 in 2019 and our agent fees which are included. We then work out our operating income, our interest on loan, the income before tax, and thereafter the net profit for each year. After this, we can then work out the net present value for option 3. Therefore, this brings us to our conclusion. So, we have option 1, option 2, and option 3. Our MVVs have been calculated and indicate that it is recommended that the client rents out her apartment on a year-to-year basis for the next 5 years and then sells her apartment at the end of these 5 years. Thank you.